Breaking news! The American banking system is on the verge of collapse as two more banks fail to meet demands. But just as panic begins to set in, the Federal Reserve steps in with a jaw-dropping move to save one of the nation's most prominent banks, Silicon Valley Bank. Will this be enough to stop the domino effect of bank failures? Or will the American economy spiral into chaos as more and more banks collapse? Stay tuned as we bring you the latest updates on this developing story. The financial world has been thrown into turmoil as two major U.S. banks have met their downfall in a dramatic fashion. The first to crumble was Silvergate, a financial institution focused on cryptocurrency ventures with a staggering $6 and $3 billion in deposits as of December 2022. The second, Silicon Valley Bank, the largest bank serving the venture capital and startup industries with a colossal $173 billion in deposits. But alas, their fortunes were not to last. A harsh reality descended upon them as the news broke that a voluntary liquidation was to begin in an effort to restore funds to their many depositors. As if the loss of one bank wasn't enough, Silicon Valley Bank, in a desperate bid to safeguard their clients, collapsed 2 days later and was unceremoniously shut down by the Federal Deposit Insurance Corporation. Oh, the horror of it all! The financial devastation that has been wrought is immeasurable, leaving countless individuals and businesses in ruin. The reverberations of this shocking event will be felt for years to come. Oh, the dread and fear that grips the hearts of men in these dark times. A specter of calamity has descended upon the financial world, casting a pall of uncertainty and concern overall. It is a frightful thing to behold, a collapse of such magnitude that has not been seen since the great financial crisis. Silicon Valley Bank, once a titan of the industry, now lies broken and defeated. The second largest U.S. bank failure ever and the biggest U.S. bank failure since 2000. And Silvergate, a bank focused on the cryptocurrency market, has suffered a similar fate, brought to its knees by a devaluation of cryptocurrencies and a sudden withdrawal of funds from its clients. The question on everyone's lips is simple. What in the name of all that is holy is happening? Should we be racked with worry and despair? Let us begin with the current situation. Despite their differences in specializations, both Silicon Valley Bank and Silvergate operate as regular banks. They collect deposits from individuals and businesses seeking to retain their wealth, and they lend that same money to those who require it, all in exchange for a fee. But how can this be allowed, you may ask? The answer lies in the concept of fractional reserve banking. Banks are free to take in deposits and lend them out, even if it means lending out more than they actually have on hand. But alas, the system is not without its flaws. When a large number of depositors suddenly seek to withdraw their funds, the bank may find itself in dire straits. Such an event is known as a bank run, and it can cause significant problems as the bank may quickly exhaust its reserves and be forced to start selling off assets in a desperate attempt to cover withdrawals. And so it was that both Silicon Valley Bank and Silvergate met their untimely end. In the case of Silvergate, the devaluation of cryptocurrencies in the year 2022 caused many firms in the industry to suddenly find themselves strapped for cash. And with the collapse of FTX last year, Silvergate faced an onslaught of withdrawals totaling nearly $8 billion in the fourth quarter alone. They simply lacked the funds to cover these withdrawals and were forced to liquidate $5.20 billion worth of assets in a desperate attempt to pay their customers. The situation at Silicon Valley Bank was dire, a calamity of epic proportions. Customers of this once revered institution have begun to withdraw funds from their accounts, leaving the bank with an insurmountable liquidity crisis. The cause of this perilous predicament can be traced back to the Federal Reserve's decision to hike interest rates over the past year. The resultant surge in traditional startup funding options has made it exorbitantly expensive for clients to keep their funds in the bank, forcing them to seek alternative options for their liquidity needs. Unfortunately, Silicon Valley Bank, much like its contemporaries at Silvergate, did not possess the necessary cash reserves to cover the significant redemptions. As a result, they were forced to sell off assets valued at a staggering $21 billion to cover the shortfall. However, the assets that were liquidated to pay for the withdrawals were predominantly U.S. Treasury bonds, which were repurchased at a very low interest rate. This decision proved to be a grave error, as the value of these bonds decreased sharply with the hike of interest rates. Thus, the two banks found themselves in a precarious position, having to sell these bonds at a significant loss to cover the redemptions. The situation at Silicon Valley Bank was particularly dire, with the bank realizing a colossal loss of $1.08 billion from the sell-down. To make up for this shortfall, they were compelled to engage in a capital-raising exercise, issuing newly created shares worth $2.25 billion. Alas, this move had unintended consequences, sending shockwaves through the investor community. Panic set in and the shares of Silicon Valley Bank plummeted to a staggering 66% in a single day, with depositors left feeling uneasy and alarmed. Venture capital firms like Peter Thiel's Founders Fund urged their clients to pull their funds as quickly as possible, setting off a deadly spiral. On that fateful day, consumers requested withdrawals totaling a jaw-dropping $42 billion, equivalent to 25% of the bank's total deposits, causing widespread devastation. Thus, the fate of Silicon Valley Bank hangs in the balance. With the situation looking increasingly grim, what will become of this once proud institution? The bank had met its reckoning, unable to comply with the unrelenting demand of its clients. Alas, their fate was sealed as the FDIC declared the bank insolvent and took control. This was not an isolated incident, for in the last week, two U.S. banks had failed in precisely the same manner. The question that now consumed everyone's thoughts was, what would become of the customers' deposits? Could this be signaling the beginning of a new, more severe banking crisis? When would the dominoes begin to fall? The fate of the depositors hung in the balance, but in a bid to maintain stability and instill public confidence in the nation's financial system, Congress had established the FDIC, also known as the Governmental Deposit Insurance Corporation. By guaranteeing bank deposits up to $250,000, they had sought to preserve the sanctity of the banking system. But in addition to that, they also manage receiverships, oversaw financial institutions, and help resolve massive complex financial institutions. Under normal circumstances, the FDIC would swoop in as it had done countless times before, taking charge of the failed institution. The first order of business would be to pay out the insured cash of up to $250,000 to each of the clients. But the enormity of this situation presented a daunting challenge, for the bank's depositors had far exceeded the insured limit. The FDIC would have to employ all of its resources and ingenuity to recover as much of the remaining funds as possible. The stakes were high and the entire nation held its breath, wondering whether the FDIC would rise to the occasion or crumble under immense pressure. The fate of the depositors hung in the balance, and the country's financial system was on the brink of collapse. The question remained, would the FDIC succeed in its mission, or would this be the beginning of a catastrophic chain reaction? The rule that once protected the average Joe in banks like JP Morgan or Bank of America is now showing its flaws. Silicon Valley Bank and Silvergate, who cater to corporate clients with substantial deposits, were left vulnerable. With only 5% of SVB's deposits insured, the possibility of more bank failures loomed, sending shivers down everyone's spine. But then, a glimmer of hope emerged as the Treasury, Federal Reserve, and FDIC released a joint statement. They vowed to insure all of Silicon Valley Bank's deposits, not just the usual $250,000 limit. With the assurance of protecting depositors, they proclaimed to boost public confidence in the financial system and defend the American economy. However, their move was not a bailout, and unsecured loan holders like stockholders were not included in the protection. The FDIC had no intention of preventing the bank from failing, meaning investors could lose everything. The fate of banking hangs in the balance as everyone wonders if this is the beginning of a new, severe banking crisis. As the American banking system teeters on the brink of collapse, they have made a bold decision to guarantee all $175 billion in deposits at Silicon Valley Bank. But why such drastic action? Is the banking system really that weak? Or is it just a ploy to calm the public's mounting fears? The truth is, it doesn't matter. Bank runs are entirely psychological, and if the common folk read only the headlines, they will start to panic. That's why the government has come in with a bazooka. telling everyone to calm down because they're here and they're not afraid to do something wild. Will it work? Only time will tell. But for now, the Treasury, the Fed, and the FDIC are holding the line, determined to stop the dominoes from falling. It's a tense moment in the continuous story of American bank failures, but for the Silicon Valley Bank customers at least, there is hope. If you want to stay up to date on the latest developments in the world of finance and banking, don't forget to hit that subscribe button and turn on notifications. And if you have any questions or comments about the Silicon Valley Bank bailout or any other financial news, leave them down below and we'll do our best to answer them. Thanks again for tuning in, and we'll see you in the next video.